Good Thursday morning from the Asia Pacific, 9 a.m. here in Hong Kong and Singapore, 10 a.m. if you're watching us out of Tokyo. You're watching the China show, by the way. I'm David Ingles with Yvonne.
Our top stories this morning, Asian stocks rise with Fed Chair Chair Powell reaffirming his view that rate cuts are likely this year.
And maybe because, or the lack of that, the Yuan is sinking and in fact close to the weakest end of its allowed trading band at this point in time. That's risking, of course, a more forceful central bank response.
And Taiwan's chip makers set to resume production after an earthquake that killed 9 people, injured hundreds, and toppled more than 24 buildings.
Welcome to the show. We should be at this point in time. We should be normally approaching the opening bells across Greater China. Markets are shut today. All that being said, there's still a whole gamut of things to watch here. Certainly front and center will be this recent pickup, I'd say recent, this last few weeks, in things like copper and gold. Certainly when you look at oil, and we're flirting with 90 on Brent, copper is at a 14-month high, and gold's just taken out 2,300. Certainly that's and your sort of equity derivative of that specific trade. We're going to get you the latest in Taiwan in just a moment here. The offshore renminbi, on the back of, I guess, the last 12 hours has seen a weaker U.S. dollar, so that's taken the steam off a little bit and the pressure off a little bit as far as EMFX goes. We'll talk about the yen in a moment because the yen has so far moved to the beat of its own dance so far. In terms of data coming through today, jobless claims, we'll talk more about this later on, and of course this whole gamut as well of Fed speakers coming out. Let me just read you some of these names coming through today. Harker, Gouldsby, Barkin, Mester, and Kashkari. And that is a partial list. There we go. Closed markets today. A reminder of, I guess, what should be up and running right now. So Taiwan is actually shut. Hong Kong is shut as well. And also mainland China. So you don't have the stock connect, no onshore rate, no PBOC fix. And of course, when you look at what's happening on Friday, Hong Kong reopens. But China, Taiwan remain closed, and then Thailand also joins this closed markets list.
You gotta wonder with a board like that, how are you gonna do a 2-hour China show?
Yeah.
But we're gonna do it anyways.
Watch us do it.
Watch us. We'll prove to you that we can. Now, the market action, as you mentioned, right? All those Fed speakers are talking about this coming on the back of those Chair Powell comments, which seem to send a bit of a relief across these markets. We saw the dollar drop quite a bit here when he reiterated that, look, rate cuts could come at some point this year. The recent uptick in inflation, he says, doesn't show any material change towards the overall picture. So that sent a bit of a relief here. You're taking that in equities is we're up about 0.8%. U.S. futures are also punching a bit higher, and we talked about that dollar drop. So as you say, taking some steam out of the renminbi, EMFX, but except for the yen. I mean, we are still seeing this G10 currency, the worst performer of the year. We're at 151.60 levels, so still on the weaker side of things. We'll see how this all plays out across, JGBs. We're still seeing those yields tick lower, but yields overall in this region, particularly on the long end, are actually ticking up just slightly here this morning, 435 for a U.S. 10-year yield. So maybe a reversal of what we saw overnight. Brent, we're watching $90, which is looking more like a possibility as $100 oil in the cards here. You did have OPEC Plus to affirm those output cuts despite an oil price at close to $90 here. So if we continue to see more gains here, are we heading close to triple digits? That's a key question here as well. And we're watching the Nikkei. We're up about 1.6%. Kospi is also up by 1%. So a pretty broad-based rally across Asia so far. And we're watching very closely commodities that you talked about, right? So I think copper's at highest since January 2023. Gold hit 2,300. Those are probably the biggest contributions to why we're seeing this ascent in the Bloomberg Commodity Index as well. So certainly one to watch here, Dave.
Yeah, I'd even just add on top of that food prices, right? So you have palm oil trading at also 14-month highs. Rice prices in the last 24 hours, I'm just looking at some of my screens here, this bright hue of green coming through as well. This really takes us into the macro conversation around the Fed, and we did hear from Chair Powell overnight, of course, and him saying at some point this year it will be appropriate to cut rates, maybe not just yet, and that's really continuing to put this constant force of pressure at EMFX. Dollar China, for example, dollar offshore 724.88. I'll give you a number right now, 0.05%, 36 pips. That's the distance between the onshore rate in the upper band of the trading limit. So we're extremely close to hitting that extreme limit. Let's bring in Marcus Wong, our macro strategist, to talk us through this. Marcus, so business, well, we're shut for business in mainland China today and tomorrow. All that being said, what can and should we expect from the PBOC when markets do reopen next week?
Yeah, definitely. I think the market is certainly bearish. I think if we look up until the point markets closed Wednesday, I think the offshore yuan was stronger than the onshore counterpart by at least 8 sessions. And I think we've seen a stronger fixings throughout the better part of this week. But, obviously that has not been enough to dissuade, investors from planting for more bearish yuan. So I think what we've seen previously, we do have in a sense, a historical record of what the PBOC has done. For example, in the fourth quarter of last year, basically they cut the foreign reserve, forex reserve ratio to 4%. They also tightened liquidity, which also saw a gain in the forward points as well as a surge in the HIBOR. Other methods they could use, of course, is through the dollar sales by state banks, basically using their strong influence on these state agencies to basically support the yuan. If you look further back, for example, let's say in September 2022, they have also increased the risk reserve requirements, essentially basically to make it more expensive to buy forex options. So all what we've seen throughout all this is that the PBOC does have quite a few policy toolkits which they can rely on. But of course, the big question at the end of the day is these are really just tools to basically strengthen the yuan marginally at the margin, if you could say, put it that way. But this generally, of course, does not lead to a general turnaround in the yuan.
So, we haven't seen some of those tools being deployed yet, Marcus. Why hasn't the PBOC, in a sense, reacted more forcefully to this weaker yuan? Is it because they're basically being held hostage to the stronger dollar story, or are they actually using the currency to help boost its economy now?
I think the general sense of the market is that, the PBOC is cognizant that a lot of the weakness in the yuan is definitely dollar-driven. Of course, you could make an argument for the better part much of last year, the yuan weakness has also been driven by, the rather bearish outlook for the economy. But, what we've seen, especially for this year, with the surge in the broad dollar, broad greenback, is that, not just the yuan, of course, we've seen all other currencies have been swept by this huge tidal wave of the dollar. Even for the BOJ, the yuan has already weakened past the previous intervention levels in 2022, but we've not seen any, strong intervention by the PBOC, by the BOJ, despite the moves in the yen. So similar to the PBOC, I think they are probably going to use some toolkits at a margin to basically bring the yuan back from at the upper end of the trading range. But, they've not taken any forceful measures because they are cognizant, again, that a lot of the moves has been broad dollar-driven. And I think this really focuses us all on the non-farm payrolls this coming Friday. And, of course, if there's a stronger than expected non-farm payroll number, when we see the dollar rebound, we definitely could see the PBOC coming with more forceful measures on Monday.
Yep, plenty of catalysts out there. Marcus, thank you. Marcus Wong there, our macro strategist joining us out of Singapore this morning. Let's turn our attention now to Taiwan, where rescuers on the island are still searching for people who may be trapped after the island's strongest earthquake in a quarter century, which killed 9 people and toppled dozens of buildings. Our reporter Qianhua Wan is in Taipei and joins us now. Qianhua, these recovery efforts are underway. Just tell us what's the latest.
Yeah, we have our latest tolls of coming in at 8. So right now the death toll still remains at 9 people, but there's a significant jump in the people that are trapped. So right now there's nearly hundreds of people that are trapped, and I think over 60 people are trapped in mines. So that's very significant what happened overnight. And we still have over 50 people that lost connection, that lost contact. So that's what we're looking for today. Like, is there any new developments on this?
Okay. Can I also, if you could, we'd like to know more about, some of the chip makers and has everybody, at least TSMC and the bigger ones, have they all resumed production at this point in time?
Well, not quite all of them. Like TSMC, for example, they issued a company filing very late last night and saying that they're resuming their equipment to around like 70-80%, but it's not to full recovery yet, and we're not seeing any other statements saying that any comments about the production line. So, but the other smaller companies like UMC and ASE has some comments about like the production is almost back to normal.
Okay, Qianhua Wan in Taipei for us. TSMC, of course, closed lower, over 1% yesterday. The city was actually out with a note talking about the impact of TSMC's operation should be quite manageable. Jeffries also largely, the downside should be limited, according to Jeffries. So generally speaking, analysts are not too worried about sort of the financial impact or production impact from this. All right. Just ahead here on Shores, we're taking a deeper dive into what's taking place across this resurgence, question mark, in the property market. Cushman and Wakefield joins us, and why they actually do see an improvement also in office leasing equipment. A reminder, markets here in Hong Kong, in mainland China, and Taiwan are shut this Thursday. We'll have plenty more ahead. This is The China Show.
These recent data do not, however, materially change the overall picture, which continues to be one of solid growth, a strong but rebalancing labor market, and inflation moving down toward 2% on a sometimes bumpy path. On inflation, it is too soon to say whether the recent readings represent more than just a bump. We do not expect that it will be appropriate to lower our policy rate until we have greater confidence that inflation is moving sustainably down toward 2%.
Fed Chair Jay Powell there speaking at Stanford and signaling that policymakers will wait for clear signs of lower inflation before cutting interest rates, which is helping at least a little bit of risk across these markets here this morning. Let's bring in Ben Emmons, Senior Portfolio Manager and Head of FI Macro Strategy at New Edge Wealth, joining us from New York. Ben, it's always good to talk to you. I mean, what did you make of the comments, from Jay Powell? And, you know, what does it tell you about just how restrictive policy is going to be this year?
Yeah, I think, Yvonne, that he's still cautious here, right? Because we do get good data out. You know, the ISM data was good, and employment data ahead of us will likely be strong because of this ADP number. In that ADP number, a lot of like components like leisures really up again. That's typically good indicators. They know that the economy isn't actually softening much more than that they initially thought of. And he spent some time on that discussion, why people had the recession wrong last year. And I think that he's still confident in that they can lower rates because he thinks that as the economy continues to expand with supply, more productivity, eventually prices come down. But he can't make that decision right now to lower rates. He has to take some time before they have that evidence. But they want to stay, I guess, confident and therefore also credible, meaning that, you can lower rates so you have reached your inflation target. And by keeping that promise out there that you're willing to lower rates and that you expected to lower rates, I guess that's why you're getting, again, a bit of a risk-on reaction in markets.
Ben, you mentioned credibility. Do you think the Fed knows where this economy will be in 6 months?
Well, there's a lot of doubts among them. I think they're looking at, right now it's a strong economy, but there's a lot of risks ahead. There was a different Fed speaker later on, David, today. Her name is Kugler, Ariana Kugler, and she highlighted various of risks, of supply chain risks and geopolitical risks and other related risks. I think that they're factoring all of those in by saying, within 6 months we can have a completely different picture. Although they obviously don't mention the election, and actually Powell, interestingly, in the Q&A said that the election didn't matter for them to make rate decisions. Right? They could actually make a rate decision around the election. Nonetheless, there's more uncertainty ahead. So I think you're right. They want to keep credibility to lower the policy rate so they've reached their inflation target. On the other hand, they don't know where the economy will exactly land in the future.
Does that leave then Ben, the dollar as the number one trade now? And does a Fed cut necessarily halt this dollar rally?
Yeah, that actually doesn't, and I think there's two reasons, Yvonne. One, the dollar has, I think, most of the lift this year from the yen. It is the weakest currency against the dollar, next to the Swiss franc. And to your earlier discussion with your colleague about the yuan, I think really it is the dollar-yen cross that's also driving the yuan a bit weaker. I think that's the story there. On the other hand, the rate cut in itself, let's say the Fed would do that now, or let's say in the next couple of months, that would essentially stimulate the economy and therefore could lift the dollar even higher. That's somewhat contrasting what you would think. Like if you lower rates, then the dollar is actually weaken, right? As an interest rate differential changes. But this may be the idea about a dollar strength in a year where the Fed lowers once the rates in a soft landing type of scenario, that you're getting a stronger dollar. I do, though, think that we're not in an environment where we have super strength on the dollar, because most of the uncertainty seems to be really priced in the gold market. That's where I think the markets are really using that as a, let's say a vehicle to price in anything on geopolitical risk, whereas the dollar seems to be more about the U.S. economy right now.
Good differentiation there, Ben. Ben, just to pivot, I guess, and let me bring China into the conversation here. New export orders, sub-gauge of PMI came out, highest level in about 11, 12 months. Do you think to some extent China's exporting some of this inflation that's keeping that relatively afloat in the U.S.? Just tie those two things together for us.
Yeah, it actually is, David. What was really interesting was the other day the PCE report came out and had a lot of categories that had been in a number of months in deflation. You're thinking of video and audio equipment and other type of related services and equipment that is imported from China quite a bit. They all popped up and higher in price. And that was right before the PMI data was released from China that showed that sudden turn upward. So I connected those two thinking, yeah, there is probably an impact coming here from this recovery in China that now seems to be getting more traction. And that is affecting, to an extent, some of our PCE data. And that I think we have to watch, right? Because for a long time, we've all talked about the China recovery, the reopening, right, would be the next sort of big macro catalyst. This was definitely delayed for, I think, at least a year. But that may become now a story. And obviously, with this visit from Yellen next week, it will be a big focus, right? Because as China is expanding its industrial base, is looking at expanding more in EVs and all those things. There's also another aspect of that, of more EV on markets pressing down on auto prices. On the other hand, the manufacturing sector lifting up so significantly can affect our price, our inflation level here. And that's what showed up in the PCE report recently.
And you do have a modest exposure in China right now, whether it's large cap ETFs. BABA is something that you guys are investing in as well. How is BABA that proxy play for you now?
Yeah, on the one hand, Yvonne, it's been sort of the bellwether of the Chinese stock market for U.S. investors. I think people always connected with BABA really from a social media and technology perspective, even though the company is going through some significant challenges, right? They had recently another restructuring that they could not really execute on. And there's been a fair bit of government news around BABA that has at times really detracted, pushed the stock down. But BABA is sort of a proxy idea of the recovery in China. If you truly want to play it, though, I think you would actually play the large cap ETF, because there's a lot of industrial names in there that I think really reflect what this recovery is about. I noted from the CSI 300 index in the sub-indices, materials, energy, and industrials, those have really turned higher since the PBOC started to push liquidity in the system. I think that's the real play here, that will be the rally ahead of us. And those sectors look cheap, right, relative to other industrial manufacturing sectors globally.
Right. Ben, Chinese fixed income has outperformed global peers, including U.S. Treasuries. The question on the equity market, just to build on what you said there, do you think Chinese equity markets outperform U.S. equity markets this year?
Yeah, that would be amazing if that happens, David. I'm not 100% sure.
If it happens, okay. Well, do you think it does?
Yeah. Well, let's say this. I do think there's the catch-up idea. Because I've been myself, I think we've talked about this in the past, quite bullish on that China reopening, but it didn't play exactly out, right? Because I think it was just a lot of effect from the COVID shutdown that just lingered longer than people had foreseen. But, the catch-up idea is definitely there. I mean, if you look at the multiple of the CSI index, about 11 times forward, I mean, that's a big discount to where the multiples are for Japan, US, and Germany, say. So there could definitely be, I think, a catch-up there. So you would think that China has some scope here to rally. Year-to-date return is already positive now for the index at 3% or about. So could it become like where the S&P is at 8%? Not unlikely.
Ben, thank you for your time. Have a great rest of your Wednesday evening, and we won't speak again, obviously. So have a good weekend ahead. Why not? Ben Emmons there, Senior PM, Head of FI Macro Strategy at New Edge Wealth. We'll leave you with some live pictures right now out of Hualien in Taiwan, where rescue efforts are underway there.
Yep, we are continuing to assess the damage, the death toll, which has climbed to 9 now. But yes, we'll continue to watch this story. This is Bloomberg. Welcome back to the China Show. Some of the other major stories that we're tracking for you today. China's central bank is promising to get more out of its existing pro-growth policies. In a statement, the PBOC says the Chinese economy is facing subdued demand and downbeat sentiment. The bank also dropped a reference to cross-cyclical adjustment, a phrase used to describe policies aimed at tackling longer-term structural problems. China is making it easier to take out loans for buying personal cars. The central bank and financial regulator say loan ratios for passenger vehicles can now be independently determined by lending institutions. Previously, the ratio was set between 80 and 85%.
Really big move across Asian chip makers right now. So Korea's second largest stock, second heaviest weighted stock on the Kospi index is getting even bigger. SK Hynix up 4%, and a couple of names, of course, over in Japan. Might be down to what's taking place in Taiwan. Spending plans out of SK Hynix, bottom of your screens. We'll leave you with a look. That's what's happening with some of these copper and commodity plays. And you know what? Things are looking up on that space. Things are looking up here. This is Bloomberg.
All right. It's a beautiful day out in Hong Kong. It's also a holiday. So certainly, if you're watching, thank you.
Yeah.
Certainly, we are trying to talk through these markets. No open
What
here
are you
today.
guys doing?
No, watch while you're having breakfast and
Yeah.
then go out and have fun. But we're not watching just a pulse check of these markets right now. It is, for the most part, risk on. I think those comments coming through from Powell reaffirming those rate cuts this year, that certainly has helped lifting equities here in the region. U.S. futures are still punching about a fifth of 1% to the upside. The dollar also sustaining that drop that we saw overnight. So certainly a bit of you can really enjoy your holiday now, Dave.
Yeah. Bulls are stretching their legs. There is a little bit of runway right now, although we're still... What's interesting, though, is the risk rally is taking place amidst this melt-up in commodity prices.
Oh, yeah.
Too, right? So Brent, as you can see, is, 43 cents, most active contract from $90. Let's take a closer look now at this pickup in residential property prices, I guess.
That may be what people are doing today, right?
Yeah, out and about. Brokers are out, maybe looking to take advantage of now the absence of all the cooling measures from the government. So, in fact, this is according to Midland Realty. So, in March, nearly 4,200 sales. This is residential. This is new homes. 11-year high. That's more than 14 times the figure that we had back just the previous month. And, of course, keep in mind, it was during the end of Feb when the government came out and said no more cooling measures, and, well, March Madness, to some extent, then ensued. Rosanna Tang is with us here on set, Head of Research, Hong Kong at Cushman in Wakefield. Well, not congratulations. Well, congratulations for making the set.
On a holiday.
On a holiday. Thank you for gracing
me.
us with your presence. What have you guys seen as far as home prices are concerned?
Well, definitely there is a shift of sentiment after the government dropping the cooling measures, right? As you mentioned, the transaction volume has picked up quite substantially or notably, and they're coming from a couple of different forces. First of all, we do see that the developer side, they are more actively launching their new sales because in last year, perhaps of the interest rate rise, perhaps of the market situation, there has been hesitating or delaying some of the new launches. And on the buyer side, of of course, no matter for the first home buyers or for the upgraders, they are more actively seeking in the market again. Some of them have been urging to the first home market, but some of them also actively seeking and upgrading in the second home market as well. And there are the third forces that we've seen is the coming from the new talents. You know, the government has also announced a Troll for Talent scheme a year ago. And then we do see an emerging and increasing number of these kind of professionals coming across the border from the mainland side that when they arrived Hong Kong, some of them has been actively purchasing in the market again because of the drop of these cooling measures.
Would you say this is a trend that can last? Or is this just something that's short term?
Well, I think it would take another month or so to observe because, as you said, currently the transaction volume in March, some of the data may still be delayed. So I think everyone is watching whether it could sustain in Q2. But at the same time, some of the fundamental changes like what we mentioned, talent schemes, the Troll for Talents, these kind of increasing trends of the incoming talents, we do see that it would be ongoing at least for another year because the policy is still there. And these kind of new driving forces would definitely help to support the fundamentals of the Hong Kong housing market as well.
When do we start to see, and this is my pessimistic side coming out, when do we start to see the impact of still higher rates? Because people coming in are locking in their mortgages are still quite elevated, unless you're a cash buyer.
So I think it's very critical to observe the interest rate movement in the second half. I think there are different forces or noise seeing in the market, with views seeing some of them are believing the rates may come down in the second half, but some of them may see that rates may peak, but it may not necessarily come down in the second half. So I think the market is still watching in this piece of interest rate movement, which will also impact on the buyer sentiment. And the residential market itself is very sentiment driven sometimes, you know. So I think it would be an indicator for us to observe.
You've been tracking some of your indications, right? This home price index.
Yeah.
Are we seeing a sign that at least a floor has been reached when it comes to home prices?
Yeah, so in terms of the pricing, we have the Cushman and Wakefield small to medium-sized flats index. And no matter for the smaller units or for the medium units, the home price did hit the bottom in February. So we do see the price rebound in March by around 1.5% month on month in March after the cooling measures has been dropped.
Right. I guess one last question before we move on to things like commercial and office. Are we still seeing developers discount just to move inventory as well? Because that goes into the future supply as well. Because a lot of the inventory was frozen last year.
Yeah. I think it depends on different developers' strategy. But overall speaking, I think most of the new launches, to be honest, they have been launching at a very close to market price, very close to the second-hand market, so as to attract the buyers. And that's why we do see that the transaction volume, in terms of the proportion, it has been refocusing in the primary units again.
What about for the office market? Are we seeing any signs of improvement there?
Yes, in a good way. We do see in terms of the new leasing area. In the Q1, we have the preliminary numbers that come out, which has jumped up by around 40% year on year in terms of the new leasing area. So this is a good sign. I think at the same time, it's also because of the market. We do see there are a couple of new projects that are going to complete or has been completed. Which,
now we can see it right across from where we
indeed.
Which,
in a way, providing some of the better quality options with affordable cost. So some of the tenants, they can do the flight to quality move with cheaper rents. Upgrading, flight to quality.
Well, what's the vacancy rate in Central, generally?
We do track, instead of vacancy, we track availability rate. So for Central, it's currently around 15 to 16%. For the overall Hong Kong availability rate is around 19 to 20%. I would say it may look high in the short term, but at the same time, as we just mentioned, while ESG elements is still very one of the tick-the-box items for some of the MNCs, it do present some of the options for the occupiers, good excuse to move around in the market for better quality buildings.
I was going to talk about the retail side because I feel for the F&B industry here in Hong Kong. I felt like this weekend people were either out of town or they were up north on the mainland. How bad is retail right now?
I think there are two sides of the retail story. On one hand, yes, in a way, we do see the rebound of tourists in town. I think currently the incoming tourists is around 70 to 80% compared to the pre-COVID level. But at the same time, as you said, we also see that Hong Kong local people, they are consuming across the border in the Greater Bay Area, which in some ways, which will also hesitate some of the retailers, F&B operators on their expansion plan. But at the same time, we still we see some new forces because of this spending habit changing, like Hong Kong people getting more used to the mainland brands across the border. Hence, there are some mainland operators, they are actively looking to lease their space and expand their footprint in Hong Kong, no matter for the lifestyle retailers or F&B retailers, or some may involve the retailtainment retailers coming across the border. So we do see it as a new forces as well.
What other trends are you watching this year?
In terms of retail?
We're all yours. Anything you think we should know?
Well, I think for this year, still the interest rate is still one of the market concerns. So this is one of the things that we closely monitor, not only necessarily impacting the residential market, but also for the commercial investment and overall market sentiment as well.
Rosanna, it's great to have you. Enjoy the rest of your holiday. Thanks for coming. You can start now. Rosanna Tang, Head of Research, Hong Kong, at Cushman and Wakefield. Of course, you can get an insider's guide to the money and the people shaking up the finance hub in our new Hong Kong edition newsletter that's out every Thursday. You can sign up through our website, Bloomberg.com/newsletters. All right, so we've been talking a little bit more about tech, not just when it comes to AI, but really Apple. This is an interesting scoop from our Mark Gurman about them really
Another good one from
looking
him, yeah.
into this push into personal robotics. This is, of course, after they abandoned that car project. They call this the next big thing, but I was just reading about it, right? It's a mobile robot that can follow users around their homes. I'm not sure if I want it.
Yeah.
I don't know.
Kind of like your 2-year-olds.
My 3-year-old is definitely like that.
Right. With less drama, I guess, sometimes.
They'll at least listen.
Yeah. Yes, I mean, according to the scoop here and some of the information coming through out of Mr. Gurman's scoop here, so it is in early beginning stages. And I think the context, too, here is the next big thing was supposed to be, of course, their effort and their foray into cars, right?
Yeah.
Which they abandoned, and, of course, that cost them quite a bit of money. They're going into robotics. Apple could gain a bigger foothold in consumers' homes. And really, I guess in some ways, this is really just the Apple ecosystem yet again at play. Although things like the smart display might be further along than the mobile bot, it has been added here to the company's product roadmap over the years. That's according to people familiar. But again, very, very early goings. And certainly, when you look at some of the milestones throughout the years of Apple, for example, right? And you actually see this when you look at percentage of revenue and how that's evolved over the years, right? From the Mac and then the, what was it called? The one with the one that used to play the music. I don't
AirPods.
No.
iPods, sorry.
iPods, yeah. iPods, right? Yeah. So, and then that disappeared.
I had all generations of that one, I felt. From the big one to the little small pocket one. But yeah, obviously it's ways to reduce that reliance on the iPhone, which continues to dominate, right, in terms of contributions to revenue. So, yeah, maybe robots. That could be the next big thing.
Why not? Okay, staying slightly on theme here. So SK Hynix, we talked about this earlier. We brushed at least very, very briefly on this massive move up in the stock today. So the company's actually planning to spend $4 billion to build its first U.S. chip plant. Let's bring in Yulim Lee, our senior Asia Tech reporter, to talk us through this. She's in Seoul first. Yulim, the scale is obvious, the significance not quite as evident, at least to me. Just talk us through the significance of this investment here.
Sure. This is a big win for the Biden administration, which has been trying to attract global semiconductor companies into the U.S. soil. And for the state of Indiana, this investment is expected to create more than 1,000 jobs, new jobs in the state and the area. So semiconductor companies have together pledged more than $230 billion, aided by President Biden's Chips and Science Act 2 years ago. Intel obviously it was the first company to win a huge grant and loans amounting to almost $20 billion. Samsung Electronics is planning a $17 billion investments in Texas, and we understand that it's expected to win more than $6 billion in grants, according to our sources. And TSMC, in the meanwhile, is expected to get probably more than $5 billion. And SK Hynix's investment is really aimed at that, and it is one of the companies that is seeking large amount of grants.
Yeah, certainly the incentives are there. Will there be additional investment then from the company?
Yes, we expect so. One of the significance of this investment is that it's really the first company to have announced to build an advanced packaging facility in the semiconductor supply chain, which is really aimed for AI products. So it is one of the most promising areas in the memory chip industry, and the company is obviously trying to increase more investment. It has already pledged more than $15 billion in the U.S. 2 years ago. So we expect the company's investment likely to go up.
All right. Interesting news there. Yeah, I think they're saying that it's the first of its kind, this project in the U.S. Yulim Lee, thank you, our Asia Tech reporter, senior reporter joining us out of Seoul. Some other stories that we're following for you today. The European Union and the U.S. are planning to enlist artificial intelligence in the search for replacements to so-called forever chemicals. These compounds are common in chip making, but have been at the center of concerns over pollution in both the U.S. and Europe. The pledge is part of a draft statement out of a joint meeting this week in Belgium. Chinese state media says Washington's response to Nippon Steel's proposed merger with U.S. Steel shows that America is the biggest threat to economic globalization. China Daily says the U.S. is drifting away from its long-held policy of openness to foreign trade and minimal interference in markets. Despite the risk of upsetting a key ally, President Biden has come out against the deal, saying U.S. Steel must remain domestically owned. Walt Disney shareholders have handed CEO Bob Iger a big vote of confidence, rejecting dissident investor Nelson Peltz's bid for a board seat. Peltz's Trion Fund Management holds a Disney stake worth more than $3.5 billion, and he's been agitating for seats to address what he sees as inadequate corporate governance. Sources say Peltz won just 31% of votes cast. The stock fell the most in more than 6 months following the result, but is still up almost 32% so far this year. Amazon is cutting hundreds of jobs in its cloud computing division. It will affect sales and marketing employees and the team developing technology for brick and mortar stores. A spokesperson says Amazon will try to find new roles for those affected. The latest layoffs come after a year after AWS held its largest ever round of job cuts. We got plenty more ahead. This is Bloomberg. Well, the CIO at T. Rowe Price says the Fed risks losing its credibility if it cuts rates too soon. Eric Veiel told us that early easing could trigger a repeat of the 1970s when the central bank took its foot off the brake before inflation was fully tamed.
One of the things that really stands out to me is if you go back to what Powell said very early on, he was a student of what happened in the 70s. And if you go back and you look at the mistake made then, it was cutting too early. And if you map the CPI to the very beginning of this cycle versus the last, it's following a similar curve. And if they go ahead and they start cutting now, I think they're in danger of making the same mistakes.
Do you perceive that as the biggest risk then, cutting too soon and not holding too long?
I do.
What would that mean for bond markets if they did?
Well, I think you would see what would happen is the spike up, and then you would have to react to that in a way that would put them on their back foot, and that would lose credibility, and you would have a really big issue for them.
I want to challenge one thing that you said, which is that Powell is a student of the 70s. Is he really? Because right now he sounds pretty much like the most dovish member on the FOMC. It sounds like he really wants to cut rates. And frankly, a lot of people are looking at that as the reason to buy stocks. Are you saying that they have it wrong?
No, I'm not saying that they have it wrong. I do think he is a student of history, and what he has to do is keep that group, find the middle ground between that group and present it in a way that presents consensus broadly within that committee and balance out the other speakers. So I think he's very much trying to do that right now. But again, I think as you look at the next several months, the idea of cutting when we are where we are from an economic perspective just doesn't, I think, make a ton of sense right now.
Which raises this question, if you do think that this inflation is stickier, and you think that the risk of a 70s type of scenario is greater than the risk of some sort of unforeseen downturn, do you just buy commodities, buy stocks, avoid bonds at all costs? Because right now it's not clear that this FOMC has the conviction to really make the right call and not have a policy error.
Well, I wouldn't go that extreme, right? So as we've unfortunately or fortunately said, we're right now in our asset allocation committee, we're actually dramatically neutral is the phrase that we've been using between stocks and bonds, which is not the most exciting fodder for the media, but that's where we are. I do think commodities, though, is really interesting. And so we are, within our equity portfolios, we're overweight energy in the vast majority of those and in different ways. And we think there are some really interesting opportunities there coming from our bottoms-up work.
The CIO at T. Rowe Price there with, of course, our colleagues at Bloomberg Surveillance. Right, some other major stories that we're tracking, this time out of China. So the European Union has begun investigations into bids by Chinese firms for a Romanian solar park, which is partially financed through the EU. The EU is growing increasingly concerned that its clean tech industries are being undercut by Chinese companies, which benefit from various levels of state support. The 27-nation bloc is also moving closer to imposing additional tariffs on Chinese EVs following an inquiry that started back in October. China Vanke suffered a fresh slump last month, joining other real estate firms with declining home sales. Contracted sales for March were $3.4 billion. That's a 43% plunge from a year back. Now, China's battered property sector is showing few signs, if any, of a turnaround. State media says banks had approved $64 billion of credit as of March to almost 2,000 property projects on this so-called whitelist. Right, so from sales numbers for March, just to recap, and by the way, the timing could not be better as far as this recap of earnings. So we're just about through earnings season. So 100% of MSCI China constituents, at least. So this probably does not include other companies that are parts of other benchmarks, but 100% of this index have reported, and so far we've seen very disappointing results.
Yeah, I think majority, 63%, had some more negative surprises. Only about a third came in more positive. So certainly that just goes to show the earnings picture hasn't quite improved yet, although you are starting to see maybe signs of improvement. I think Ben Emma was talking about the industrial sector, energy. Certainly those have been exports. The outperformers that maybe could still be winners for the quarter. It brings us to a very interesting discussion that Ray Dalio really posted on LinkedIn recently on him, to answer the question of why I invest in China. I mean, it's been a decades-long sort of journey for Ray Dalio, and he basically said, look, it's a 40-year relationship. He's not one to kind of invest during booms and busts of the cycle, right? And what he says is, I'm neither a fair weather friend nor a fair weather investor. And he says, in order for me to diversify, I need to have China in that playbook.
Diversify properly, right?
Yes.
So he understands that there are problems, but those risks are manageable in his case, right? So to be able to, I think one of he's always said, and I could just understand the number here, he needs 15 or more uncorrelated streams a part of that asset base. And of course, you can't get that really without China. And China really serves that purpose as well.
And he says manageable because he believes policymakers are going to be smart, they're going to be courageous about how they address those issues in the economy. But yeah, certainly worth a read on why he's sticking to China, of course. Obviously, we've been talking a lot about commodities as well. I mean, take a look at how gold, that seems to be one of the biggest contributions to the Bloomberg Commodity Index as well. Is that the inflation hedge everyone's talking about? We're still above that 2,300 level. Brent, ever so close. We're about half of a cent to $90. Well, a lot more on the way in the next hour. You're watching The China Show. Welcome back to The China Show. A reminder, of course, markets are closed in China, Hong Kong today and tomorrow for the Tomb Sweeping Festival. Hong Kong markets, though, reopen on Friday. So it's a weird week. That's how we're checking Japan at the top of this hour here. But yeah, we continue to see this rally resume. I mean, when you have the dollar drop against almost every currency except for the yen, I think that's a good signal for people to continue to buy equities here today in Tokyo, Dave.
Yeah, we're back about 40,000, as you can see on your screens. And certainly the yen, not just it didn't listen, it's actually weakened even as the dollar continued to fall, right? So at 150, 165, in fact, about a few hours back, we did get extremely close again to that 152 handle. So again, nothing much has changed as far as intervention watch, as far as Japan is concerned. At least there's a separate but similar conversation to be had when you talk about a Chinese currency, because we're getting extremely close, or we did get extremely close going into this long weekend, near the upper end of the trading band, that allowed trading band 2% of the midpoint right now. As Yvonne is pointing out, though, this relief rally across risk assets, as you can see, Nikkei, Kospi, ASX, we're up about 1%, give or take, across that. All things equal, 9 cents at 1%. Very good indicator of risk appetite, of course, is the euro dollar. ISM services came in slightly weaker than expected. That drove the dollar lower. Euro was higher as well. Japanese 10-year yield, just to mention as well, the next 90 minutes or so, there's a 30-year bond auction in Japan, which we'll preview in just a moment there. Iron ore, what you don't see on your screens, things like gold and copper, for example, leading the rally. Copper, 9,000 a pop, metric ton. Gold's trading at 2,300 as well. Apart from this, 2-year yield, I mean, at 4.7%, right? It doesn't seem like the Fed's about at that level, right? You'd be hard-pressed to win an argument that the Fed would be cutting in the next 2 or 3 months, but they could. They could. Chair Powell, of course, had a lot to say about that, effectively saying that it does remain the case that the Fed will probably need to cut rates this year, that it will be appropriate to start lowering rates, but there is no rush to do so. In fact, let's listen into his words exactly.
These recent data do not, however, materially change the overall picture, which continues to be one of solid growth, a strong but rebalancing labor market, and inflation moving down toward 2% on a sometimes bumpy path. On inflation, it is too soon to say whether the recent readings represent more than just a bump. We do not expect that it will be appropriate to lower our policy rate until we have greater confidence that inflation is moving sustainably down toward 2%.
Right, so that's the Fed chair. Coming up, we have just this whole list of speakers over the next 24 hours or so, right? Mr. Harker, Goolsbee, Barkin, Mester, Kashkari, just to name a few. What you're looking at on your screens really is our Bloomberg Economics Fed Speak Sentiment Index, natural language processing AI algorithm effectively here. We've had about 6,000 Fed speaking engagements all the way back to 2009, if you take that back even further as well. And effectively, what you're looking at is amalgamation, if you will, of where we are. So this is obviously almost like a macro chart to you. It follows effectively if you juxtapose inflation on that as well. What effectively you're seeing, just going through all the noise and I guess sidelining all that noise, is we're getting less hawkish. Yes, it's going to take us a while to get to the other point, but Yvonne, I think the path hopefully is clear that we are headed to, at some point, lower rates ahead.
Yeah, for more, let's bring in our Mark Cranfield from MLive to talk us through, what we heard from Powell. I mean, obviously, there seems to be this debate that's heating up now that whether they can actually deliver on those 3 cuts this year, or is it going to be 2 or 3? I mean, what's going to be determining that for the next coming days or weeks?
Well, the thing which traders have the most difficulty with, being patient while the data unwinds. That's the difficult job that everyone has over the next few months. We've heard, as you say, the Fed speakers are getting closer to neutral in their outlook now. Obviously, there was a period where they needed to be very hawkish to get interest rates up. They've done that. It's pretty clear that they won't be raising interest rates again. But now, as you say, the big debate is whether they can start decreasing interest rates in the middle of this year, or will we have to wait, as some Fed speakers think, right until the end of the year? Will it be the fourth quarter? So now we're in this tricky period where the data in the United States has been a bit too firm. It's been a little bit hotter than they expected from the Fed. By now, they were thinking that the inflation would have already met their targets. The bond market was certainly anticipating that. At the beginning of the year, we had deeply inverted yield curve with generally yields on the way down. That's been reversing slightly. So the bond market is taking back some of those expectations. And we're now nicely balanced in the point where we could have a rate cut in June or July, or maybe it's even going to be pushed slightly further. And it really depends on the inflation data, the jobs data, and a couple of other points which come out over the next few weeks. And really from here, the bond market is going to find itself battered between one side and the other. The net result could well be good for the stock market, but maybe for the US dollar, it becomes a slight negative as we go further into the second quarter.
And, while we wait, Mark, for that eventual pivot from the Fed, do you think yen traders, yuan traders will find themselves in similar situations to the one they're in currently, where there is a risk of intervention, that things will have to be nimble despite us being range-bound?
We've probably got two slightly different stories here. I'll take the yen first. Because the Bank of Japan have made it fairly clear that their pace of interest rate moves is going to be pretty slow, and the US interest rates are staying stubbornly high for longer, that makes it fairly clear that the US dollar against the yen, the natural path is for it to go higher. But obviously, from Japan's point of view, there comes a point where they can't afford the yen to weaken that much. They'll have to do something about it. So intervention is quite likely, but given the background circumstances and the contrast between monetary policy, even when the Japanese come in to support the currency, it probably won't advance that much. So they'll probably, let's say they came in at 152, they might be able to move it to 145, but then they'll probably find it just gradually creeps back up again because the interest rate pace is so different between the two countries. In terms of China, they've almost in a no-win situation. The fundamentals do not justify a stronger yuan. You need a positive catalyst to make your currency much stronger. China just doesn't have that. And I think the central bank in China understands that. That's why they're restricting the pace of weakness. They're not stopping the yuan from being weak per se. They just don't want it to run away. They don't want people to think it's a one-way bet where the yuan can get weaker and weaker, because that would encourage outflows from the country, and that would be very bad overall. So they really got to play this delicate game where they would like to ease monetary policy a bit further for the sake of the economy. But if they do that too quickly, it will just weaken the yuan very fast. So really, they're in a tough position, but eventually the yuan has to get softer.
And Mark, we're going to switch to commodities because it's just been so hot now, whether it's copper, whether it's gold. Let's start with gold, right? You mentioned it in the question of the day. The yellow metal reached 2,000 in 2020, 12 years after touching 1,000. We're at $2,300 now. How quickly can we get to 3,000 now?
Well, if you look at some of the crazy things which are happening in the financial world, if you look at companies like Nvidia, how quickly it became a $2 trillion company. If you look at Bitcoin going back above $70,000 recently, all those kind of extremes suggest it isn't crazy to think that gold could reach 3,000. It might take a few years, but it is certainly not out of the realms of possibility in the context of what's happening in the asset world.
Mark, thank you. Question of the day there for our viewers. When do we get to that next 1,000 milestone? Mark Cranfield, our MLife strategist. By the way, later on this hour, we'll be talking about really how this is playing out, right? So a weak market in China, stock market, is really pushing a lot of investors to diversify into gold as we wait, I guess, for the economy, to Mark's point, to gain more traction and just to make it really a stronger case for Chinese assets. All that being said, the data recently in China has been good. PMI numbers have been encouraging. The City Economic Surprise Index for China, I just had a look at it right now back to the highest level in 10 months. Does this momentum continue? Andrew Polk, co-founder, partner at research and advisory firm Trivium China, joins us right now. Andrew, a pleasure to have you on the show. It's been a while, mate. The conversations around this momentum we're starting to see, well, potential momentum, the encouraging data we've seen so far out of China, how far do you think this lasts? Is the bottom of the economy behind us?
I think so. The data, as you said, has obviously been good to start the year. Solid investment, even in the private sector. So starting to see positive overall private and sector investment, despite the fact that property investment continues to contract, and that's a big chunk of private sector investment. So that's going well. Industrial production looking very strong as well. Even consumption looking okay. Exports as well. So the real question I think policymakers in Beijing have to ask themselves is still the biggest chunk of the positivity in economic activity in China's economy is on the supply side. And the question is, can the supply side of the economy keep going long enough to hand off to the consumer eventually, right? To see demand side resumption come along with it and really build sustainability into the recovery.
And what do you think is the answer to that? Because obviously we've seen plenty of fiscal measures late part of last year. Is there more policy room to maneuver here when it comes to whether they need it or not? That's really one question. But is there more of a need for demand-style stimulus?
There's absolutely a need, but policymakers have pretty much, in no uncertain terms, said we're not going to pull, the levers that would be most effective when we think about demand-side stimulus. So specifically, they've said for a couple of years now, we are not going to do explicit cash transfers to households, which is obviously what the developed economies did during the pandemic to get, consumption going again. So they can do it. They probably should do it, but they've ruled it out. So that's kind of a non-starter. I think the expectation is that they hope that enough of there's a trickle down from the supply side of the economy to boost jobs. Hopefully that spills into better performance in the equity markets. Overall, people start feeling better about the economy generally. And then the further, we're still, feels like a lifetime, but we're only 15 months out from the end of the zero COVID policy. So as people get further and further away from that, do they start to want to normalize their consumption habits after having built up some savings? That's the big question. I think that's what policymakers are hoping, but it's unclear if that trade-off is going to happen. I was just in Beijing, and you can just feel still a very palpable sense of that the main thing holding back the economy is just lack of confidence among households and small businesses. So they need a jolt to confidence. They have designed a path to go through this, supply side support, and they're hoping that will hand off, but still a big question.
That's a good point you make, because sometimes when people ask us where's the growth, sometimes I just point to, we have a chart here. Have a look at household savings, right? That's where growth is. It's in the bank. It's not as if people don't have money. They're just not spending it. Andrew, to that question, given the unique circumstances of this economy right now, of the many economic indicators we can obsess over when it comes to China, what do you think is the most material important at this point in time to track?
Well, property, specifically sales and prices. Most of the economy's weakness can still be explained by the extreme sluggishness in the property market. And that, has a ton of different effects. It not only, creates some of the industrial overcapacity that everybody's talking about, it also, means that things like steel go into the global economy and are dumped into other emerging markets. But it also has a huge wealth effect for Chinese households, so they feel less wealthy, and it impacts their confidence as well. So the key to any stabilization is whether or not demand comes back for housing. I think that's going to be a little bit more of a lagging indicator, though. So it's going to take a while still for that to happen. There's some interesting things happening on the policy side when it comes to stabilizing the property market, but very little, just like I was saying, on the macro economy, very little demand side stimulus has happened. Similar in the property market, policymakers haven't really figured out the demand side. It's mostly been on the supply side as well. So that's the big, area to watch. And it's the thing that hasn't, picked up materially at all in the past year and a half.
And what more needs to be done? I mean, is it more about helping, when it comes to leverage and refinancing of these developers, or is it more about really stimulating that demand and really trying to boost home sales now, Andrew?
So I think the approach right now, and we'll see if it works because it's pretty new. It's only been happening for the past, 3 months really, is on the supply side, they're doing two things there. So on the supply side, they're doing one thing, which is to address developers' financing issues through this whitelist program where local governments, put these projects on whitelists and they try to push banks to lend to those projects. So that's, that's new, really just started kind of towards the end of February. We'll see as the data for March rolls out whether or not that's having any impact. On the demand side, what they're trying to do is build affordable housing through the three big projects, right? So they're really, the idea there is that you boost some construction activity outside of the traditional commercial housing sector and in the affordable housing sector. That still leaves the commercial housing sector, the traditional, where people go and actually buy their homes, most people, with very little policy support. And so that's the place where we still don't see much action. What needs to happen? Probably what really needs to happen is policymakers need to allow a bigger downward price adjustment so the market can find a clearing price and that people will finally say, okay, this is the bottom. I can come back into the market now. But that could obviously cause quite a bit of volatility. And, that's something that policymakers aren't particularly comfortable with.
Andrew, you touched on this earlier on, and, part of the confidence issue was whether these projects were going to get completed and finished. Might be a stupid question. I'm wondering what you think about it, though. If China has enough money to save the stock market and support it, the national team coming in, ICBC, for example, on a separate note, announced it was going to be providing $41 billion to tourism financing. If we're talking those kinds of numbers, why don't they just finance all these projects? That might be simplistic, I don't know. Or is that a moral hazard question?
Well, it's partly a moral hazard question. It's also one of those issues where you got to get everybody on board, and the banks simply don't want to pursue this program. So the policymakers don't have full control of the banks. The banks know they're in a tight spot because they know they're going to, if they lend more to the property sector and property developers continue to be in trouble, then they have issues with their own balance sheets, asset deterioration, and they have to raise more capital. So they're pretty loath to get on board as well. The other big policy piece that they do have that they could finance through, of course, is the pledge supplementary lending facility where the PBOC lends through the policy banks. Yeah, exactly, to try to get some of these affordable projects going. And they've already done $500 billion, as you talked about, $41 billion, $500 billion, a billion there, a billion here. Soon we're talking real money. They've used that before, right, to stimulate the property sector. And last time, 2014, 2015, they did about 3 trillion renminbi. So there's actually huge upside. And I think that's the one policy lever that they really have in their back pocket that if they decide to pull could finally get construction activity moving again.
Andrew, great stuff. We'll have more from Andrew Polk coming through from Trivium China. He's staying with us. Still ahead on the China show, oil extending a rally that's brought prices to a 5-month high, of course, after that OPEC Plus meeting, reaffirming those supply cuts. The outlook for energy markets coming up. This is Bloomberg.
We've agreed that it's important to both of us that we don't want to decouple our economies. We want to continue, and we think we both benefit from trade and investment, but that it needs to be in a level playing field.
That was U.S. Treasury Secretary Janet Yellen speaking on the way to her second China visit in 9 months. This trip partly aimed at pressing her counterparts in Beijing, this time to talk about the overcapacity that they're seeing in the industrial sector. We're back with Andrew Polk, co-founder and partner at research and advisory firm Trivium China. It's an interesting trend that we've been seeing, right, where it seems like China wants to export its way out of its problems, and maybe that's leading to some geopolitical tensions with not just the U.S. but the EU as well. I'm just wondering, is there anything the U.S. can do to address this issue of overcapacity?
very little the U.S. can do directly, and I think that's why, or the Europeans as well. So I think that's why they're sort of just, making a big stink about it. I think, you guys had a really good piece on this where, explaining that while the overcapacity narrative is really kind of catching on, overcapacity is really not a macro economy-wide problem. There are swaths of it, and even more so, it's not an issue that affects significant amount of trade with the U.S. in particular. And so I kind of think this narrative is going to move along pretty quickly. I think it's kind of a convenient, cudgel to something else to hit the Chinese with. But I don't really see it impacting the U.S. economy that much. And as to your question, U.S. policymakers don't really have any avenues to address it anyway.
Is this even a conversation over capacity we'd be having if it was not an election year in the U.S., Andrew?
I think so. I mean, the Europeans really started this. They have a lot more at stake here, specifically, when it comes to, electric vehicles and components in electric vehicles. And this is kind of the second time in the past year that Americans have kind of hopped on a talking point that the Europeans have started. The Europeans, really came out first with the de-risking agenda when it comes to, European companies in China rather than decoupling. And the Americans very quickly said, yeah, that sounds good. We don't want to decouple. We just want to de-risk. But overall, I think this is not going to be an issue that is going to stick around into the election year. The overcapacity issue is kind of a little bit too esoteric, I think, for most U.S. voters to care about.
And just broadly speaking, is it just me, or are these two sides starting to really like each other ahead of the elections, Andrew? Just contextualize that for us, this relationship or situationship.
Well, yeah, I mean, a lot of hard work. Situationship is a good term for it. A lot of hard work has been put in to stabilize the relationship. I credit the Biden administration for sending over a spate of high-level, cabinet secretaries and other officials throughout last year. They took some political heat for that, that they were cozying up to China or whatever, going soft on China. But, China took that at first skeptically, but eventually saw the steady drumbeat of senior officials coming over and thought, okay, maybe there's some real room here for us to start a conversation. That obviously culminated most recently in the Xi-Biden meeting in San Francisco, and has, marginally improved since then with ongoing conversations at, the leadership level, which took place in the past 24 hours, and then additional working level conversations. So, the administration here, the Biden administration, has said, after Bali in late 2022, we didn't have any of these phone calls. And so we're just trying to keep the good vibes going to an extent. I'm sure they wouldn't characterize it that way, but they do want, as they would put it, more responsible management of the relationship. And so I think that's exactly what we're seeing.
Andrew Polk, it was great to speak with you. Hit us up next time you're this part of the world, of course. Co-founder, partner at research and advisory firm Trivium China. Right, plenty more ahead. This is Bloomberg.
All right, checking these markets here right now, and the chip stocks in particular, obviously with the news of SK Hynix making that big investment into that first U.S. chip plant in Indiana. So the stock is up some 4%. That's lifting a lot of some of its rivals and chip makers here today. Tokyo Electron, Renesas up about 3.5% as well. Also, there's been some at least slightly good news when it comes to TSMC. They're expected to resume some operations after that massive earthquake. And we're watching still these China proxies, even with China shut for the next 2 days. Iron ore certainly is one, seeing a bit of reversal there. So we're back below that 100 level at $96. Copper is at the highest we've seen since January 2023. And futures are slightly up when it comes to China here, about 0.5%. We got plenty more to come. This is Bloomberg.
We're just moving into the Tokyo lunch break, and risk assets are bid across the region, led by Japan. I guess to some extent the earnings season has helped. To some extent, some of the recent data has helped. The BOJ, the fact that they raised rates and then it seemed as if they cut rates, maybe that's helped as well. A weaker yen has certainly helped things along. If I haven't used the word help enough, help me, please stop. Topics index 2746 right now, 1.5%. We have a 30-year bond auction coming up, which we'll preview in just a moment. That comes out in the next hour. Stay tuned for that. In the meantime, though, let's dig deeper into this Japanese market, which really smells like cherry blossoms.
Yeah, you can see a little bit on that live shot near the Imperial Palace, right?
Oh, yeah.
I know a lot of friends are there. Take a look at the cherry blossoms this time of year. And it's not just the spring weather. It's not just those cherry blossoms that are brightening investors' moods these days. Historical data also shows that this quarter is a traditionally bullish season for stocks. For more, let's bring in our senior Asia stock reporter, Hideyuki Sano, in Tokyo. I know he's out looking out for those cherry blossoms, but also looking for fresh signs of seasonality in this equity market. What does history usually tell us?
Hi there. Yeah, I mean, I wish the weather is better because the cherry blossom looks much better. But apart from that, the April-June quarter is actually the best quarter for Japanese stocks if you look at the long-term historical data. There's no clear consensus on why that is the case, but one thing I can point out is that it's the start of the new Japanese financial year, so a lot of Japanese investors have cash to work, and so that could be one reason the market tends to do well. Now, so far this quarter, we had a wobbly start. The Nikkei is still down since the start of the week. Many market players chalk it down to profit taking by institutional Japanese investors. So a lot of people think that they're likely to rebuild their position sometime later. And also, foreign investors tend to buy in April. Perhaps they're trying to front-run Japanese buying. We, of course, don't know for sure. But in any case, historical data does suggest that we tend to have a very positive factor during this quarter.
Okay, so I think we're running out of things to focus on because everything else is certainly lined up as it pertains to this bull market in Japan. Is there anything specific you think investors should be watching out for at this point, given the seasonality you just underscored?
Yeah, actually, that is a good point. And this quarter is not a usual quarter because there's so much focus on corporate governance at the moment. And the Tokyo Stock Exchange has been pushing companies to do more to basically boost stock prices and valuation. And a lot of companies are expected to unveil their thinking on corporate governance and shareholders' return when they announce the full year earnings in coming several weeks. So this is one of the biggest focuses at the moment. And given that the investor had elevated expectations on corporate reforms, it's going to be very interesting to see what kind of actions Japanese companies are going to take. Now, just yesterday, Itochu, one of the big five trading companies, announced its capital plan, and basically they said they will raise dividend payout ratio to 50%, and stock prices rose sharply. So that is perhaps a good indication that if companies do announce a plan to boost their shareholders' return, then that might also bode very well for their stock prices. But that said, the market has risen so much during the first quarter, so we'll have to see how this will play out.
Well, history is certainly on the side of the bulls here. Hideyuki Sano, our senior Asia stock reporter in Tokyo for us. I just had a glance here at my Bloomberg terminal. In fact, April is actually the very best month, and there's not even a close second here for global stocks. So just keep that in mind. So April does have some tailwinds here. Right, gold is actually doing very, very well, and just going into the second quarter, risk assets, maybe Ben Emmons, our guest earlier on, did point out that gold is one to watch as a proxy for conversations around the Fed 23.20 all-time highs in that. Brent is nearing 90. Copper's topped 9,000 again. And palm oil is one to watch as well. We're at 17-month highs as far as palm oil is concerned. Our question of the day is on the first one and on gold.
Gold. So we hit 2,000, right, in 2020. It went from 1,000 to 2,000. It took 12 years. So how long is it going to take before we get to 3,000? At this rate, it could happen, right? So we'll certainly watch that one. And certainly there's a lot of things that are driving that, not just when it comes to, it's a safe haven play, it's an inflation hedge. You're seeing central banks buying up gold left and right, too.
Right.
And also, we talked about China investors looking to swap some stocks with gold bars,
some
too.
Shicomp for XAU. There we go. If you get our vibe here.
We're such nerds.
Well, speaking of oil, that's another thing too, right? So J.P. Morgan. This conversation, I believe, some of our colleagues overnight talked about potential targets here for oil prices. That is.
I think it's J.P. Morgan. That was saying, look, the price targets for, I think, 85.90 is going to be pushed forward a little bit. You have, I believe, the likes of Morgan Stanley that have also boosted their Brent forecast for this year. Let's hear more from the J.P. Morgan call, though. This is the head of global commodity strategy, Natasha Kaneva, who says crude prices could continue to climb.
Our baseline view assumed, since unchanged since last June, assumed that we'll be hitting $90 by May. So it does seem that it's, being brought forward by about a month and will be there by April. But again, that as you absolutely correctly pointed out, the risk is that actually on the way to our price forecast, we will be hitting $100 as well.
I have to correct myself. It's Bank of America, but I think Morgan Stanley was part of that too. But yeah, boosting the oil price to $86 for Brent from $80 back in January. Let's bring in our oil and market reporter, Sharon Cho, to talk a little more about this OPEC Plus meeting. I mean, the fact that they still kept these output curves when oil is rising to close to $90, I mean, does this just solidify this rally in some ways?
Yes, I think we can say that because the OPEC Plus coalition recommended no policy changes at its meeting on Wednesday. And that means OPEC Plus will maintain its output cuts until the end of June. And that's about 2 million barrels a day, roughly 2 million barrels a day of cuts that will remain in place. So that indicates that global oil markets will be kept very tight over the next few months. And we already know that oil markets have been shaken up by the rising geopolitical tensions in the Middle East. And Ukraine's attack against Russian refineries have kept oil prices elevated over the last few weeks. And all of this added, it will mean that supply may be affected, and OPEC Plus decision to stick to its cuts will lead to a tightening of supply. And IEA has said that OPEC Plus looks like it's set to ensure that international oil markets will be kept in a slight deficit in the second quarter. So, we're expecting it to translate to higher oil prices, higher gasoline prices at a time when, many consumers are faced with inflation worries, and the central banks around the world are, trying to do their jobs, but it's going to be a bit more complicated with higher oil prices, I think. But I do want to point out that there are still issues with compliance within OPEC Plus when it comes to their quotas. And for instance, Iraq is producing more oil than it agreed in March again. So it missed this target, and it's something for us to keep an eye on.
Yeah, compliance is certainly almost ingrained in this story, isn't it? Prices, Yvonne and I were just talking about $100 oil as flagged by some analysts. Do people think that's possible?
Yes, I think people think it's more and more possible. Brent crude is flirting with $90 a barrel this morning. As we saw JP Morgan's Natasha Kaneva talk, she thinks that $90 a barrel could be reached this month. And Russia's supply cuts are among the factors that could push oil prices to $100 a barrel by August or September. And also the U.S. gasoline prices will spike. So, we have Ed Morse at Hartree Partners, who used to be with Citi. Now thinks oil prices will probably trade in $70 to $95 a barrel range. So I think there is more and more expectations for oil prices to keep rising, and OPEC Plus cuts will keep the market very more and more tight than expected, I think.
Sharon Cho in Singapore for us, our oil markets reporter. Just ahead here on the China show, why Taiwan's earthquake could offer Beijing a chance to express sincere gestures toward the island as relief efforts get into full swing. That discussion is just ahead. This is Bloomberg.
Well, Taiwan has rebuffed Beijing's offer for disaster assistance following the island's strongest earthquake in 25 years. Taiwan's Mainland Affairs Council issued a statement saying, quote, "There is no need for the mainland side to assist us." Rescue and recovery efforts are underway today. We have continued to report 9 people have been confirmed dead, 1,000 injured, and around 100 people still trapped. And we are learning more about chip makers, though, in the island are now restarting operations.
Yeah, as we, I guess, make our way further from that event, of course, yesterday. In the meantime, though, certainly when you look across media, state media, China state media to be more precise here, has actually used the earthquake to reassert Beijing's claim over Taiwan. Xinhua News Agency as well as CGTN specifically used the phrase China's Taiwan in their reporting. Let's bring in Karishma Vaswani, our Bloomberg opinion columnist, to talk us through her column that underscores really this point. And just take us through this, Karishma. How real might concerns be that China could be exploiting this for political gain?
Yeah, David, very real, simply because we've seen China do this before. I want to cast your mind back to that devastating earthquake in 1999 of similar magnitude that killed more than 2,000 people with thousands of buildings leveled. Now, at that time, Beijing also offered its assistance and Taipei rejected it because the aid that Beijing said it was willing to hand over to Taiwan had to go through, China said, its own borders because it saw Taiwan, it sees Taiwan as part of its own territory. You know, 25 years later, you've had a similar disaster take place in Taiwan. Thankfully, for now at least, the death toll is not that high and the infrastructure seems to have held up remarkably well in the first instance. And obviously, as the rescue and search operations continue, that must be the priority for Taiwan to be able to focus on the welfare of its people without any political exploitation of this situation by China.
In your column, Karishma, you mentioned that Beijing should provide sincere gestures. How so?
Yeah, Yvonne, you know, frankly, a sincere gesture would be to simply get out of Taiwan's way. As we have talked so many times on your program, one of the things that China consistently does to antagonize Taiwan is to send warplanes and vessels in the seas and skies around the island. It's a way for it to assert its authority, its ownership and claim of authority over Taiwan. This is extremely frustrating for the Taiwanese military that consistently has to combat these sorts of operations. Now, before the earthquake struck on Wednesday, we saw an example of that with some 30 warplanes and 9 vessels being sent across the median line between China and Taiwan. This morning, however, there hasn't been that number of vessels or planes making its way across, even though this happens on a daily basis, and often you see these sorts of gray zone activities stepped up in a time of crisis. But for now, at least, it doesn't appear to be the case. The other thing that China could do, and I don't see Beijing doing this at all, is sort of, you know, accepting the fact that there has been this huge outpouring from governments around the world. We've seen Japan, the Philippines, Paraguay, the UK, and obviously, other nations as well, coming out and saying that they stand by Taiwan in this time of need. And I think that's really significant and interesting as well, because they've been much more vocal about being able and being willing to help during this humanitarian disaster. And I think that's quite symbolic and significant as well.
Right. I think it's also worth pointing out, though, that soon after the disaster, I'm just looking at this SEMP story, that Beijing's Taiwan Affairs Office offered the island disaster assistance. I guess the other point, and just looking at the other side of this, Karishma, I mean, when state media has this phrase, China's Taiwan, Karishma, isn't that standard standard language anyway. It just happens to be that the news flow and the news cycle has focused so much on Taiwan that when you look at state media, you do notice these things, for example. But one would otherwise look and you'd find is anyways my point.
Yeah, and I see what you're saying there, but I think it must be emphasized consistently that China sees Taiwan as part of its own territory, and Taiwan sees itself as a self-ruled democratic island, and that is, the crux of the problem, right? Because consistently, as you point out, in state media in China, this will be a matter of course. This is how they describe Taiwan on a daily basis. But for the Taiwanese, at this very critical point in their timeline, I suppose, one way to say it, it's really important for them to be able to focus on the matter and the issues at hand rather than be distracted by any sort of political games that might be played on the part of Beijing.
Karishma, great to have you back on again. Bloomberg opinion columnist Karishma Vashmani joining us out of Singapore. Make sure to check out her column this morning. We got plenty more ahead. This is Bloomberg.
The U.S. Treasury curve is currently elevated like this, shaped like this as well. So we're looking at slight uptick, maybe a steeper one if you squint, across a 30-year yield at 452. Speaking of coming up later today, initial jobless claims and the jobs report, of course, to wrap up this week. Speaking of that, in the Fed, the CIO, T. Rowe Price, says the Fed risks losing its credibility if it cuts rates too soon. He also told us that early easing could trigger a repeat of what happened back in the 70s when the central bank took its foot off the brake before inflation was fully tamed.
One of the things that really stands out to me is if you go back to what Powell said very early on, he was a student of what happened in the 70s. And if you go back and you look at the mistake made then, it was cutting too early. And if you map the CPI to the very beginning of this cycle versus the last, it's following a similar curve. And if they go ahead and they start cutting now, I think they're in danger of making the same mistakes.
Do you perceive that as the biggest risk then, cutting too soon and not holding too long?
I do.
What would that mean for bond markets if they did?
Well, I think you would see what would happen is the spike up, and then you would have to react to that in a way that would put them on their back foot. And that would lose credibility, and you would have a really big issue for them.
I want to challenge one thing that you said, which is that Powell is a student of the 70s. Is he really? Because right now he sounds pretty much like the most dovish member on the FOMC and sounds like he really wants to cut rates. And frankly, a lot of people are looking at that as the reason to buy stocks. Are you saying that they have it wrong?
No, I'm not saying that they have it wrong. I do think he is a student of history, and what he has to do is keep that group, find the middle ground between that group and present it in a way that presents consensus broadly within that committee and balance out the other speakers. So I think he's very much trying to do that right now. But again, I think as you look at the next several months, the idea of cutting when we are where we are from an economic perspective just doesn't, I think, make a ton of sense right now.
Which raises this question, if you do think that this inflation is stickier, and you think that the risk of a 70s type of scenario is greater than the risk of some sort of unforeseen downturn, do you just buy commodities, buy stocks, avoid bonds at all costs? Because right now it's not clear that this FOMC has the conviction to really make the right call and not have a policy error.
Well, I wouldn't go that extreme, right? So as we've unfortunately or fortunately said, we're right now in our asset allocation committee, we're actually dramatically neutral is the phrase that we've been using between stocks and bonds, which is not the most exciting fodder for the media, but that's where we are. I do think commodities, though, is really interesting. And so we are, within our equity portfolios, we're overweight energy in the vast majority of those and in different ways. And we think there are some really interesting opportunities there coming from our bottoms-up work.
All right, commodities bottoms up. You take a look at when it comes to what Eric Veiel was saying, speaking on Bloomberg surveillance, saying the whole complex looks pretty interesting here right now, not just when it comes to the energy plays. You take a look at how these precious metals are doing. We continue to see this rally. Gold still at that record. We're well above that 2,300 level here right now. Silver, has yet to catch up really, but we are seeing a decent bid across silver with that trade here this morning as well. Same with platinum, same with palladium, the like. Gold, though, certainly is taking a lot of the spotlight, right? It's been all the rage, Dave, even on Chinese social media, if you can imagine. This is trending on Weibo right now.
Yeah.
There's a woman in Hangzhou who sold $83,000 of her stock holdings for gold bars because it's harder to like stocks these days. That's according to her, right? She's reassured by her trade, she says. But to some, gold is starting to look a little bit frothy again. Some reactions is that, it's a bit overhyped, gold, and people are about to be trapped the way that they did by stocks. Some are calling the peak already when it comes to gold prices. Too late to enter now. And some even saying gold has room to go even higher, though, on the geopolitical risks out there. So they're saying $193 per gram by next year for sure. There's a lot of conviction in that one. How much is that in ounces?
I had to do a conversion right now. So an ounce is about 28 grams. So if that's a bullish call, then that's 28. So 28 times the current level would translate to about 5,500.
What?
So effectively double where we are right now.
That's quite a goal.
This so-called, okay, I wrote it down here, the short XUA, long XAU trade, if you get our drift. We're nerds here, aren't we? There we go. Short XUA, that's the A50 futures contract. XAU is spot gold. There we go. Okay. No easy way to pivot here to Japanese currency. Did my best, racked my brain, stop laughing. Intervention risk. Okay, so despite the drop in the dollar overnight, you do see that somewhat, of course, in this move on the right side of this chart to your screens. But, the fact that we did got even very close again to 152, and the last time they came out was a few days back when they came out with fairly firm verbal intervention against speculators. The fact that we're back here again goes to show, and we'll get an initial, the next major indicator of demand for Japanese paper, if you will. 30-year auction is coming through today, and I think the coupon's at 1.8%. The results of this auction will be out in the next 30 minutes or so. I believe that should be coming out. There we go. Thank you so much. 900 billion yen is what they're selling today.
Yeah. I mean, given what we've seen with the reaction to the yen, and even when it comes to JGBs, it's been so muted since they did hike rates for the first time in 17 years. So you got to wonder, is there still appetite for these long-end JGBs here in this market? You take a look at how the rest of the region is looking like here today, of course, with Hong Kong, China, and Taiwan closed for the Qingming. We're still seeing a decent rally. We're up 0.8%, still around those session highs here on the back of those Chair Powell comments. We got Bloomberg Markets Asia coming up next. Stay with us.